Most people think they're building wealth, but they're actually destroying it. Ray Dalio, the billionaire who predicted the 2008 financial crisis, has 3 rules that completely flip traditional investing on its head. This is the man who turned a 2-bedroom apartment operation into the world's largest hedge fund, managing over $150 billion. And what he says about protecting wealth goes against everything people are taught. Here's the issue. The average person loses money trying to get rich. They chase hot stocks, follow trends, and end up worse off than when they started. Sound familiar? Number 1, stop speculating. Because markets are a zero-sum game, let's start with something that's going to upset a lot of people. Dalio says, stop trying to beat the market. Just stop. When asked by David Rubenstein what the best investment is for a middle-class American, Dalio didn't recommend some exciting tech stock or cryptocurrency. His answer was boring but powerful. Treasury Inflation-Protected Securities, also known as TIPS. But here's the kicker. He followed up by saying something most financial gurus won't tell someone. I don't think that people should be speculating in the markets because it's a zero-sum game and they'll probably be the loser. Think about that for a second. This is coming from someone who built one of the most successful investment firms in history. He's not saying markets are bad. He's saying that for every winner in speculation, there's a loser. And statistically, the average person is going to be on the losing side. Why? Because when someone buys a stock hoping it goes up, there's someone on the other side of that trade. And often, that someone is an institution with billions of dollars, teams of analysts, and sophisticated algorithms. Bridgewater Associates alone spends hundreds of millions of dollars every year just on market research. That's who the average investor is competing against. Dalio has even admitted that despite all that spending and expertise, his fund witnessed widespread underperformance over a 6-year period. If the professionals struggle, what chance does someone trading on their phone during lunch break have? TIPS work differently. They're government bonds that adjust with inflation. When inflation goes up, the principal amount of these bonds increases. When they mature, investors get either the original amount or the inflation-adjusted amount, whichever is higher. Plus, they pay interest twice a year. Dalio calls them the safest investment available right now because they guarantee a real return above inflation. In current conditions, that's a bit over 2% real return. Not exciting, but it protects purchasing power. The deeper principle here is about shifting focus from chasing gains to protecting what's already there. Dalio's philosophy is straightforward. Protect existing wealth rather than risking it in pursuit of high returns. For someone who built a fortune, that's interesting advice. He's essentially saying the first rule of wealth is don't lose it. This ties into another one of his core beliefs. Big losses are not compensated for by big gains. If an investment drops 50%, it needs to gain 100% just to get back to even. That's why avoiding catastrophic losses matters more than scoring big wins. Think about it like this. If someone has $100,000 and loses 50%, they're down to $50,000. To get back to $100,000, that $50,000 needs to double. But if they had just protected that $100,000 and grown it by a steady 10%, they'd be at $110,000. The math isn't complicated, but people ignore it chasing excitement. Dalio also warns against recent performance bias. Just because something went up doesn't make it a good investment now. It might just be more expensive. The dot-com bubble is a perfect example. People saw internet stocks skyrocketing and jumped in, thinking past performance meant future gains. Most got crushed when the bubble burst. His message is clear: stop gambling. The house usually wins. Instead, focus on investments that guarantee protection against the silent wealth killer, inflation. Number 2. Diversify with uncorrelated assets to reduce risk by 80%. Here's where things get really interesting. Most people think they're diversified because they own different stocks, maybe some tech, some healthcare, some energy. Dalio says that's not real diversification. Individual assets within the same asset class are usually about 60% correlated with each other. That means when the stock market crashes, most stocks fall together. Owning 20 different stocks doesn't protect anyone if they all drop at the same time. Real diversification means owning assets that don't move together. Dalio has a specific formula he calls his Holy Grail of Investing. He recommends building a portfolio with 15 good, uncorrelated return streams that are balanced by risk, not by dollar amount. This is the key insight most people miss. Traditional portfolios split money evenly, maybe 60% stocks, 40% bonds, but that's not risk balance. Stocks are way more volatile than bonds, so even though they're only 60% of the money, they represent about 90% of the risk. When stocks crash, the whole portfolio gets hammered. Dalio's approach balances the risk contribution from each asset. This is called risk parity. The result? He claims this strategy can reduce portfolio risk by about 80% while keeping the same expected returns. That means someone could potentially double their return-to-risk ratio with just the first 3 uncorrelated assets, and it keeps improving as more are added. His famous all-weather portfolio puts this into practice. The typical allocation looks something like this: 30% in stocks for growth, 40% in long-term bonds for stability, 15% in intermediate-term bonds, 7.5% in gold as an inflation hedge, and 7.5% in commodities. Why this mix? Because these assets respond differently to economic conditions. Dalio breaks down the economy into 4 possible seasons. There's rising growth, rising inflation, and falling inflation. No single asset performs well in all 4 environments. Stocks do well when growth is rising. Bonds shine when growth is falling. Gold and commodities protect against inflation. By holding all of them, something is always working. The beauty of this system is that it doesn't require predicting the future. Nobody knows which economic season is coming next. The all-weather approach covers all bases all the time. From 1996 to 2020, this strategy averaged about a 9.7% annual return. Not spectacular, but incredibly consistent. The S&P 500 only averaged 7.6% over the same period, with way more volatility. But here's the part people forget. This only works if the portfolio gets rebalanced regularly. As assets grow at different rates, the balance shifts. Stocks might outperform and suddenly represent 50% instead of 30%. That changes the risk profile. Dalio recommends rebalancing at least annually to maintain the proper mix. Why does rebalancing work? It forces a contrarian approach. When something has gone up a lot, some gets sold. When something has performed poorly, more gets bought. This is the opposite of what most people do emotionally. They want to hold winners and dump losers. But markets are cyclical. What's hot today might be cold tomorrow. Dalio also emphasizes geographic diversification. Don't just invest in one country. When evaluating countries, he looks at 3 things: financial health, whether they promote healthy competition and productivity, and the risk of war or conflict. Neutral countries with strong finances and competitive economies tend to perform better over time. The core idea is simple: spreading investments across truly different assets, different classes, different geographies, different currencies, creates a resilience that single strategy portfolios can never achieve. It's not about getting rich quick. It's about making sure wealth doesn't disappear when the unexpected happens. Number 3, focus on real returns and protection against currency devaluation. The third rule might be the most important in today's economic environment. Dalio is obsessed with real returns, not nominal returns. What's the difference? Nominal returns are what an account statement shows. Real returns are what someone can actually buy with that money after accounting for inflation. This matters more now than ever. Dalio points out that the United States has $38 trillion in debt and is overspending by 40%. That's not sustainable. So what happens when countries accumulate too much debt? They don't default. They devalue. Throughout history, when nations go broke, they print money, devalue the currency, and create artificially low interest rates. The person holding bonds receives terrible real returns. Their money might grow nominally, but it buys less and less. Dalio draws parallels to 1971, when President Nixon ended the dollar's convertibility to gold. Before that, gold was the foundation of money. After that decision, the dollar became purely fiat currency, backed by nothing but trust in the government. Since 1750, Dalio notes, 80% of the world's money has disappeared, and what remains has lost most of its value. This is why he recommends holding 10 to 15% of a portfolio in gold. Gold is unique because it's not someone else's liability. Stocks represent ownership in a company that could fail. Bonds are a promise that someone will pay and they could default. Even cash is just paper backed by government promises. Gold is gold. It has intrinsic value that's been recognized for thousands of years. Central banks around the world are increasing their gold reserves right now. Why? They're worried about sanctions and geopolitical uncertainty. After what happened with Russia's foreign reserves being frozen during the Ukraine conflict, many countries realized holding only dollars or euros is risky. Gold can't be sanctioned or seized as easily. Beyond gold, Dalio emphasizes those inflation-protected bonds again. Tips guarantee that purchasing power gets maintained. If inflation runs at 5%, the bond adjusts so the real value stays constant. This is radically different from a normal bond paying 3% interest while inflation runs at 5%. That's a 2% loss in real terms. The shift in mindset here is crucial. Don't think about how much money is in an account. Think about what that money can buy. $1 million sounds like a lot, but if inflation runs at 7% annually, it loses half its purchasing power in about 10 years. Someone might still have $1 million on paper, but it only buys what 500,000 bought before. Dalio warns that the current debt cycle is reaching a breaking point. He compares it to Ernest Hemingway's quote about bankruptcy. It happens slowly, then all at once. For years, decades even, governments can accumulate debt without obvious consequences. Then suddenly the bond market revolts, interest rates spike, and everything changes. He's not predicting when this will happen. He's saying it's inevitable at some point, and positioning needs to happen before the crisis, not during it. Once everyone realizes the problem, it's too late to protect wealth. The prices of safe assets skyrocket, and the opportunity is gone. This is why his advice focuses on preparation over prediction. Build a portfolio that can handle multiple scenarios. Hold assets that protect against currency devaluation. Accept lower nominal returns in exchange for real wealth preservation. It's not glamorous, but it works. So here's the bottom line that ties it all together. Dalio's 3 rules are really one philosophy: preservation over speculation, diversification over concentration, and real value over nominal numbers. These aren't tactics to get rich overnight. They're principles to stay rich over decades. The billionaire who predicted the 2008 crash isn't telling people to swing for the fences. He's telling them to protect what they have, spread risk across uncorrelated assets, and focus on real purchasing power instead of account balances. In a world of $38 trillion in debt and currencies losing value, that might be the smartest advice anyone can follow.